What if I told you that the very ETFs paying you those jaw-dropping 12% or 15% dividends are actually eating away at your original investment? Most dividend investors are unknowingly falling into a silent killer called the high-yield trap, watching their net asset value, NAV, disappear while the monthly checks keep landing. This is the financial secret Wall Street doesn't want you to know. Chasing the highest yield often guarantees you'll lose capital in the long run. I've found 15 high-income ETFs that have delivered strong distributions and achieved positive price appreciation since day one. These are the only funds that prove you don't have to trade capital stability for high cash flow. Stick around, because by the end of this video, I will name my single top pick that combines a massive yield with over 50% max timeframe growth. Now, before we dive into the list, we need to understand the mistake most investors never see coming: the erosion trap. This trap starts with the simple, dangerous belief that a bigger dividend always equals a better outcome. Seeing a fund advertise a 12% or 15% yield is compelling, but those payments may be funded by selling the fund's own holdings or returning your initial capital back to you. On paper, this return of capital, ROC, looks like steady income. In reality, it steadily cuts into the structural base of the fund, leading to NAV erosion and shares losing value over time. You could collect distributions for years only to find your original investment is steadily weathering away. Don't be that investor. If you find this distinction helpful and want to see more content that protects your capital, please hit the subscribe button and turn on notifications right now. Your subscription helps us bring more deep dive analyses like this to the financial community. The key difference in safe high-income strategies is that the payouts come from market strategies designed to produce new cash flow, such as covered call writing. This approach generates distributions without dismantling the existing portfolio. So, the takeaway is simple. Always compare the current yield to the fund's price performance since inception. If the chart shows years of NAV decay, the headline yield is masking a deeper problem. Income alone is not the finish line. Income plus capital stability is the real objective. This brings us to the first group: ETFs that strike a balance between income and growth. Let's look at funds that demonstrate it's possible to earn meaningful income while also seeing growth in your account balance. JPQ provides NASDAQ 100 exposure using a covered call strategy. It has a historical yield around 10 to 11% combined with a 13% price return since inception. JPI offers large cap equity exposure, paying 8 to 9% yield with an impressive 14 to 15% price return. SPYI is a quieter contender with a yield in the 8 to 9% range, but boasts the strongest appreciation at plus 25% max timeframe return. Their common thread is that the yield comes from robust option strategies layered on top of stable, established large cap stocks. That's why they appreciate instead of erode. But the stability is only half the battle. How much income you keep after taxes matters just as much. More investors are asking, are there ETFs structured for high income and tax efficiency? This is where the second major distinction lies. The IRS doesn't care how appealing a yield looks if it's taxed as ordinary income, quickly reducing your net return. SPYI and SPYI stand out because their distributions are partially classified as return of capital. ROC allows you to defer part of the tax bill until you eventually sell the shares by lowering your cost basis. It is a powerful timing advantage for compounding, not a tax-free pass, but it allows you to retain more income up front. If you've learned something new about ROC or the high-yield trap, smash that like button now. The final group proves you can combine growth sectors like tech and crypto with steady income. QDVO blends large-cap growth companies, Nvidia, Microsoft, Apple, with a 9% distribution rate. QQQI layers a covered call program on the NASDAQ 100 for an observed distribution rate of almost 15%. GPIQ from Goldman Sachs uses a dynamic strategy to balance a 40% total return with an 8 to 10% distribution. Even highly volatile assets like Bitcoin are reframed into income with funds like BTCI and BITY. For instance, MAGQ focuses on the Magnificent 7 for a striking 35% annualized, weekly distribution, though the risk is higher. These funds all monetize volatility using option premiums, trading some upside for compelling, steady cash flow. But the real question remains. Which fund delivers the most sustainable income and growth? My top pick from this entire list is undeniably SPYI. SPYI combines a massive 56% max timeframe price return with a reliable 12% distribution rate and the crucial tax deferral ROC component. This pairing of immediate cash flow plus proven capital appreciation is the unicorn of the high-yield ETF space. Remember these three takeaways. Prioritize ETFs with positive capital gains, understand the ROC portion, and always verify the latest documents. Choose the funds that pay and protect your capital. Let me know in the comments. Which of these 15 ETFs are you researching first?